Okay, welcome everyone. So I'm just going to give every other person about a minute before we actually kick off. So we're going to be starting by 8:05. So let's wait for others. So you can go ahead to invite or remind some other persons so that we can kick off at 8:05. I'd like this class to be as short as possible so that we can all get what we need to and go back to our daily activities. Thank you. Can you hear me? Can I have a thumbs up if you can hear me?
Recording in progress.
Okay, thank you so much. So we're going to kick off right now. So you guys, the fact that you actually decided to show up today means that you're very, very intentional about your finances. And there's so many ways we can start investing. And this is one of the ways, stocks. So welcome to the little you need to know to start investing in stocks. Okay, so the big question is, why should we invest, right? A lot of us grew up knowing basically about savings. But the reason why we're here is because for some reason, we want to earn more than we're already earning currently. So we're going to go into a lot of things. I don't know if everyone here is currently on the group, because on the group chats, we have the course content in full so that you have an idea of the things we're going to cover during the course of the next 5 weeks. So I'm going to do a quick rundown of the course content so that you can also, let's say, plan and prepare mentally. So we're going to talk about investing, basic introduction into investing today. We're going to talk about the why of investing. We're going to talk about some disclaimers and some myths like the poll we had today. We're going to talk about financial goals. We're going to then go to the main juicy topic, stocks. We're going to know the meaning of stocks, understand why stocks is a thing or what is exactly is the benefit of the whole essence of the stock market. We're also going to get to know the types of stocks, but that is for this week. And for next week, we're going to go into full details because I don't want to bombard everybody with so many terms, right? So for next week, we're going to go into full details, but today is introduction. So I would like everyone to sit, relax. If you have a pen and paper, I'll advise you to do that because honestly, most of the things I know about stocks, I paid for it. I paid for it both for classes and also with experience. Like I tested the market myself and I've experienced a lot of things, but we'll get to know all of these things as the time goes by. So for today, investing, why should we actually invest? Now, there are so many reasons why we invest generally, whether it's because we want to earn more. Generally, when there's no amount of money you're going to have that's going to be enough. For example, the rich people, they don't just retire when they've clocked billions. They don't retire when they've clocked hundred of millions. They still want to monopolize the market to gain more because human needs cannot be exhausted. Our desires, our needs, our wants, it does not come to an end, right? So this is one of the reasons why a lot of persons want to earn more than we're currently earning. So another reason why we should invest as opposed to just saving is because of the term inflation. Now, inflation is the continuous rise in the value or the price of goods as opposed to the value in money. So let me explain this in an easier term. So when a good, for example, foodstuffs, the prices of foodstuffs keep on increasing, but the price of the worth of our money is not following the price of the goods. So for example, this is a Samsung phone. Let's assume when I bought it in January, this Samsung phone was worth 200,000 naira, right? So imagine if I didn't buy the Samsung phone, I kept the 200,000 naira and said I wanted to buy it later. So you hear people say, oh, it's because of inflation, because by the time you're coming later, a few months' time, This Samsung phone that was 200,000 in January is no longer 200,000. As a matter of fact, the price would have increased, right? So that means that my 200,000 naira can no longer afford to pay for a 200 for this Samsung phone that was 200,000, because the price and the value of this Samsung phone, what it takes to make this Samsung phone has increased. So 200,000 naira can no longer pay for it. So the official definition of inflation is a continuous rise in the prices of goods and services over a period of time, but there is no rise in the value of money. In Nigeria, we are all very, very familiar with the fact that if you have the money now, buy it now because of the increase in our inflation rate. Currently, Nigeria's inflation rate is stated at 20%. What does that mean? It means that our money loses 20% of its value with time. So CBN and other financial institutions, they give us the rates of our investments, or sorry, the inflation rates of the country monthly. So if they say in August, inflation rates was 10%, and then by the end of August, it means that whatever was worth 100,000 naira would be 10% more by the end of August. So it's just like the percentage at which the value of money is going down and the percentage at which the goods is going up. I don't know if this makes sense in any way. But if you have any question, please feel free to ask. I want this class to be as interactive as possible. The whole essence that everybody's going to benefit from it and not just hear me talk and go back home, but you understand everything to the best of your knowledge. So that is inflation, right? How the prices of goods are going up and our money can't buy it anymore. So if I had 100K at the beginning of August and now they said the inflation rate is 20%, it means that I've lost 20,000 naira from my money. My money can purchase, we will need 20,000 naira to purchase what it could at the beginning of August, right? So that's one of the reasons why we can't just save. The next thing is increasing our earnings, because we want to, we can't work 24 hours a day, and we want to actually live better than the 8 hours of work we're doing. This is one of the reasons why we why we invest, because we want to earn while we sleep. We want, even while we are awake, we want to earn more than the services we are offering. So big disclaimer, I did a poll and big disclaimer. So this how I fit make 1 billion in 4 weeks was a question that someone asked when we were filling the form, because and very real. Why actually like added it to this slide is because it's very real. I've heard a lot of people say that, oh, I just want to invest in stocks because I want to become a millionaire, or because I want to make more money, or I want to, you know, become rich or something. The stock market is not a get rich scheme. It does not flip money overnight, and it's not 100% safe. As long as you don't know what tomorrow is, there are risks in it. So I would say explain why there are actually risks. But as long as you can't guarantee some things, then there's an atom of risks in it, right? So if you want to invest in stocks because you have a debt to pay within the next 3 weeks, I'm sorry, this is not the investment for you. You're in the wrong group. But if your plan is to actually increase your earning, right, then you're at the right place. So let's move forward to the myths. We've heard a lot of people say the reasons why they haven't yet started investing in stocks is because it costs so much to start. You need a lot of money. You need, like, you know, millions or hundreds of thousands before you can actually start investing in stocks. But the truth is that it doesn't apply, especially because right now a lot of companies, fintechs have created for us to be able to access these our homes as low as 5,000 naira. You can literally go as low as that. So when I was when I started investing in stocks in 2019, I started with 5,000 naira, right? So I bought about 3 stocks, and one of the stocks I bought was Netflix. When as low as 5,000. I think I divided into three. I did like 2,525, something, or 2,000, something like that. That's how cheap I actually started investing in stocks. So you can invest with as low as 5,000 naira, literally. And you can buy as a fraction of 0.000 something worth of a company. So meaning that you don't have to have all the money, right, before you actually start. The next common misconception is that only the rich can buy stocks. Well, the whole point of the stock market is so that it comes out to the public. So it's no longer just those that have the money or that just have the access to these companies that can invest in it. It's anybody. The whole point of we saying it's a public market is because it's open to every and anybody. So it's not just the rich that can invest in stocks. It's not just the rich that can actually be involved in the stock market, but the public, the general public. And another myth I'd like to address in this class, is investing is hard and it takes too much time. So investing in stocks some people say you need some mathematical knowledge, some economical analysis, accounting, background of so many other things. It's not as deep. It's not that deep. So with as long as you can read and write, as long as you can analyze things, you can think. You not even think, as long as you literally can do anything. As long as you signed up for a social media platform, you can easily invest in stocks. That's easy. It's as easy as that. All you have to do is just learn how it works. That's it. So one of the facts that I would like to point out to you guys when it comes to investing, not just in stocks, is that consistency is, for me, is the key to wealth. Compounding interest. They call it the eighth wonder of the world because compounding interest is, I don't think I can define any source of your value over time other than compounding interest. It's one of the ways you actually will make a lot of money from stocks and almost any other investment by compounding your interest. So how does compounding interest works? It just means that over the percentage, I have there's a topic for this so that we can go deep into compounding interest. So it just, when you say compounding interest, means adding it up together, right? So the logic behind consistency and compounding interest is that you have to be consistent in investing. You have to be consistent in putting in the work. You have to be consistent in watching, right? You have to be consistent in learning and growing. And if you can be consistent in your investment or your investing life or your investment plan, then you are closer to wealth than if you want to be jumping from one get rich to another. So another thing is that risks can be managed through diversification. So yes, there are risks in it, but it doesn't stop us. After all, if you wake up and you go to your house, if you go out, if you're going to work, there's risks in going out. There's risks in your house, there's risks in going out. So we can all manage these things. And one of the ways we manage it in the stock market is by putting our eggs in different baskets, casting our bread onto many waters. So whichever one produces profits, yeah, awesome. And then it helps us to stand. So it's just like thinking of the foundation of a building. It has 4 pillars, right? And as long as you have 4 pillars to a reasonable extent you're carrying, then imagine out of those 4 pillars, you now have like 4 more. So four in the other middle. So even if this edge decides to fall, it's standing. So that's one of the ways we manage risks. And stock investing is a long-term game. It's not an overnight switch. It's a long-term game. So you would make a lot of money over time rather than immediately. It's a long-term game. So the last thing I'll talk about for investment is financial goals. So I want us at the end of this class, this is going to be our task. I would like us to decide and plan for our investment lives. We have to be intentional about it. Plan what you want to do. How do you want to come about it? So if you decide that you want to save, you're going to decide how much you want to save monthly or weekly or daily, or how much do you want to invest in stocks in a month, in a year. You decide it, you make a plan, you write it down, you figure out how it works, right? So you have a short-term plan, you have a pattern that you follow that will help you keep up with your long-term goal, right? And then when I'm talking about short-term plans, I'm talking about 1 to 5 years. So this is what I want to do within this time period. So if I decide that I want to start investing in stocks and I want to start with as low as 5,000 naira, I can decide to make it 5,000 naira monthly, depending on what you can do. Some people can decide to do it 50,000 naira monthly. Some can decide to do 500,000 naira monthly. So we make a plan. What can work for you, right? The truth is, money, what we have is not enough. But if it's not enough and you can take a little out of it and keep for the future, you still manage. It's managed that is managed. How I talk to people about saving is that if you lose 2,000 naira today, will you kill yourself? No. So why don't you remove the 2,000 naira and put it to one side so that you can gather the money and invest in stocks? And then that stocks will now give you fruits, right, at the end of the day. So it's as easy as the name. That's SeedVest. So and scale. The other idea of it is a seed going to the ground. It could be 1 or 2 seeds that goes to the ground, but we all know that what comes out is a bountiful harvest. So if you decide to eat your capital, which is your seed, and you do not plant it, when it's time for harvest, you have nothing to harvest. So if you can keep just a little and plant, right? And then at the end of the time of life for the plants to grow, then you're going to have a bountiful increase in the time for harvest. So this is financial goals and plan, long-term and short-term investments. Just make a plan. You could start with savings. I want to save this amount of money because I want to invest this amount of money. So you use smart goals and plan for yourself accurately. And we also reinvest. So just to make a plan from now to now, break it down. Don't do in 5 years, I want to invest 200,000. No, it starts with today. What will I do today that will make me have this amount of money? What can I do this week differently? What can I do this month differently? It is literally still compounding interest because in the end, it's all the steps you take from day one to a year that you're actually going to reap out of. So financial goals, I'll talk about it more at the end of this class. So let's go down to the ones we've been waiting for. Stocks. So what are stocks? Official definition: stocks is a proof of ownership of a fractional percentage of the company that's issued it. So a stock is a piece of a company. It's a part of a whole. So for example, look at a pizza. Pizza, let's assume is a pizza of 8 pieces, like it's divided into 8 pieces, right? When I'm holding one piece of that whole pizza, when we now bring it in the corporate world or in the stock markets, we call that a stock. So a stock is a percentage of a full company. So let's assume I sell wigs, I sell hair. Why do people invest in stocks, or what exactly does stock incorporate? A lot of people that have businesses and you've done your CAC, you would know that we have shareholders. Like some business, some companies, you have to have your shareholders starting up. Now, these shareholders mean that these are the people that will share in the profits. These are the owners of this company, right? So that is on the small scale. Now, we have the public market and the private market. If I'm starting a business and I can't fund my business, there are a lot of ways I can get money. And one of the ways to get money is by telling the public to come and buy. So that is literally the foundation of stocks. So I decide that like I said, I have a hair business and it's worth 1 million. And I want to expand. I want to start making the hair from Asia and importing it, in fact, even exporting it down to other countries. but I need 10 million naira and I don't have 10 million naira. I went to the bank and the bank told me that, sorry, we can't borrow you 10 million. If we borrow you 10 million, you pay us back 3 million, I'll be 5 million in 1 year. If I have the 5 million, if I could make that money, will I come and borrow from you? So what most companies then do is they will now go out and say, okay, announcement. There's this hair business. So if you want to invest in it, come, I will sign a part of it to you. And then automatically you become a shareholder of my hair business. So you own a percentage of my whole company. So I have a million. I can decide that I want to break my company into 10 pieces so that I can have everybody contribute 1 million and we can make up the 10 million, right? So if I decide to break my company into 10 pieces, it means that automatically I only own 10% of my company, because a million out of 10 million is just 10% of the whole. So other people can come and say, okay, I'll give you 1 million and they'll take 10% of this company. So this is how, let's say, the shareholder division works. So when I've done that, I now can raise 10 million naira by strangers investing in it. This is like the smaller brand of the big one. Now the big picture is, after I've raised 10 million, someone, let's assume Mr. A was one of the persons that bought a piece of my share and gave me a million naira. He can decide that I want to use my money for something new. He will then announce, please, who wants this stock, this hair stock business? I can either buy it from him or I can leave him to sell it out. If he's selling it out, he can decide that I want to sell it for 2 million naira. And automatically, anybody that buys it at 2 million naira has said that the worth of this stock is 2 million naira. Do you think if you had A or B or C, number 10 or in the whole 10 division, you will leave your stock at the 1 million? No. Somebody has bought it for 2 million. It means that it can be worth 2 million. So automatically my stock has increased because somebody thought it's wise to buy my stock at 2 million naira. It means that my business has increased 100%, because if I can, I think I'm talking too much. Please, can you guys comment? Do you understand? Like, am I being too technical? Should I explain it again? Should I calm down? Should I use easier terms? So I hope everybody understands. I'm still going to deal with stocks in next week's class, right? So don't stress. So don't stress about it. I'm still going to deal with stocks, but I just want us to get, I really want us to get the basics right now, so that whatever I'm talking about next week, when I'm going on technical, you would have gotten the foundational level of it. Okay, so I'll carry on. Seems like everybody's getting it. So if you see the illustration of the picture, yeah, you can see a company to one side, you can see the fraction, the pie chart, and you can see the handshaking. I just used that to illustrate. I think I would have gotten an illustration with money or something. So how it works is, a company has listed themselves to be public, meaning that they're accessible to everybody, anybody. So all you have to do is tell them is to pay the price that you want to pay, the price that anyone is willing to sell you for a percentage of their company, and automatically become a stockholder of that company. So Microsoft currently is a firm that is listed on the stock exchange. If I want to own a part of Microsoft, I want to be part of the shareholders, all I have to do is check out how much Microsoft is selling a share in their company, make a purchase for the number of shares I want, and automatically with those number of shares, I'm already a stockholder. So if I decide to buy 10% of Microsoft, I own 10% of, like, I own the real Microsoft. I own 10% of Microsoft. So that's how it is. So let me go back to a unit share. A unit, like one piece of a company, is called shares. So a lot of, even me myself, when I'm explaining stocks, I interswitch with shares and stocks. So it's like saying a share like your parts, then the people that owns those shares are called shareholders. That is where the term shareholders come from, the term shares come from. So stock means that you own a fraction of a company. Simple. So yes, oh, I think I already jumped the gun because I explained this. So how does it work? Equity. Companies wanting money, they decide to go out to the public to get money. So some of us know Shark Tank. Let me just explain this finally. Some of us know Shark Tank, right? Where people go to meet about 4 or 5 investors, like they're actually like millionaires, if not billionaires. So they pitch their businesses to them, and then they choose an amount to invest in their business and a percentage. That is, if that's what we call a private market. I'll explain it in the next class. So that's what we call a private market. Most businesses that we know, even those that are not listed on the stock exchange market, they all have shareholders. Whether it's your tech company that is not a big tech company, whether you call it a startup, or even NGOs, they all have shareholders, right? So these shareholders are what we call the private market. Then when we decide to bring it out to the public, that's when we now have the public, everybody having the access to buy a piece of the company. Then companies use stock to raise money. I explained that. So that's literally how stocks work, or that's why we have the term, or why we have something called stocks. So we're going to talk the types of stocks. We have different types, we have different classification, but I'm just going to talk about these two for now. The next class, we're going to go deep into what stocks is. I wanted this class to be 30 minutes. So I would like to finish within like the next 5-10 minutes. I don't want to put too much. I want it to be small, so that we can get it and follow through. So we have 2 types of stocks. We have common stock and the preferred stock. Now, these types and classification, a lot of persons also have the issue with different mixing it up with blue chip stocks and all, but class, this introductory class, we're just going to talk about the type of stock. Then we'll talk about the classifications in the next class. So a common stock are those stocks that the shareholders invite you for their meetings. The shareholders are willing and will pay you dividend for their stock, right? So the reason why we have this division is because some companies, like, be careful so that I will not overload with information. Okay, so I was talking about common stocks. So common stocks are those stocks that usually they're big grown stocks, like stocks that companies that have been there for a really long time, companies that have expanded, they have made their money, they have their feet stable on the ground. These are usually common stocks. So a common stock are those stocks that they allow their shareholders from 0.00% to the owners of 10-15% to vote, right? They also allow their shareholders to receive. Why this is important is because of the rights you can claim from the company, from these companies. So in as much as every company is listed out on the stock exchange market, some companies give you rights to some things as a shareholder. Some companies do not give you that right. So preferred stocks, I'm just going to compare these 2 stocks, right? So the common stocks give you ownership to their company. They see you as part of them. That's why they will invite you for corporate meetings. That's why they'll pay you. You will even have voting rights. Like, you can literally vote for different things to be implemented in the company. Then usually, because they are grown, they are already big companies, their cash flow is lesser. What kind of company will I say is a common stock? Coca-Cola. Coca-Cola is in almost every country, even not in every country. And when they're even entering those countries, they're even buying out other things. To a reasonable extent, Coca-Cola cannot really make 100% in revenue, scarcely. Like they've almost expanded their limit. They're just, they're just maintaining. Let me just put it that way. So even if they are growing, they can't grow as high as a stock that just came into the market, or they can't grow as high as one drink that just entered the market and then it still has potential to reach other countries. But Coca-Cola is grown and they are big already. So to a reasonable extent, their capital returns is low, but they pay dividends. So they share their profits with the owners of their stock, right? And shareholders can be well represented and they have control in the company. The only downside to common, not the only, one of the downsides to common stocks is the fact that if, for example, the company has to liquidate, if they want to sell off or they want to go off the stock market, the shareholders will not be the first to collect their pay. So company X is on the stock market and company X is having an issue. Maybe they don't want to sell to the public anymore. They want to be a private company. Or for example, they're bankrupt and they're owing people, they're owing banks, they're owing investments firms and all. The first people to pay usually are the banks. If they own the government, they pay the government. The big shareholders are the first people they pay. Then what is left? The people that are left, which is the public shareholders, will not share what's the tiny percentages that is left after they paid banks, and usually it's close to nothing. That is if people have not even finished selling out in loss to leave the market quickly, meaning that the value is reducing. Why opposed to preferred stock? Preferred stocks usually are small companies. They actually are more predictable. They have a higher percentage. They have possibility of increasing in assets. For example, Tesla. Tesla is as big. I mean, in the possibility for expansion. Tesla is not. I'm not recommending. Please, I'm not recommending any stock. I'm just trying to explain. I'm not recommending any stock yet. So stocks that have potential for growth, they barely pay dividends because they're still trying to improve. They're still trying to get better. So they won't share their profits yet with you. And they don't let people in for they don't let shareholders to vote. They don't have rights into the decisions of the company. But if for whatever reason they have to liquidate, their shareholders are the first persons to actually get settled. You pay those people off. You pay all of the public first before they will now start settling the banks and the others down. Now, preferred stocks, they are mostly not what we call the value stock. They're more of the stocks that have value because they have the potential to grow. They have the potential to give you capital returns. And how you earn from preferred stock is by capital return. By common stock, mostly how you earn is by dividends. So what are dividends? Dividends is the payments that a share in the profits or the payment in the profit that a company gives out to its shareholders, right? So when a company decides that, oh, we made this amount of profit last year, we'd like to give it to our shareholders, we'd like to share it among them. So they divide it by our number and give everybody a part of it. So these are like, let's say, the classifications of stocks. So most stocks are either in one or the other. Most companies that are listed on the stock exchange are either one or the other, right? So we have other like ways we actually we value or we segment stocks. There are other ways we do that. There are stocks that we refer to as blue chip stocks but I'll explain everything in details by the next class. So this is what I'm going to touch today for today's class, right? And now we can go ahead and ask our questions. Let me see. I need to. So if there's anybody that has any question, if there's anything you would like me to clarify, if there's anything you would want me to go over again, just let me know. Thank you so much for joining. Have a lovely night rest and see you all on Saturday.